Welcome to Siller & Cohen's Wealth Unpacked series, a collection of short videos designed to simplify financial and estate planning concepts. Hi, I'm Randy Siller, co-founding partner of Siller & Cohen, and I'll be your host for this session. Our topic today is qualified opportunity zones and opportunity zone funds. Let's start by talking about the purpose of qualified opportunity zones. They are an economic development tool designed to spur development and job creation in distressed areas. And so far, they've done a pretty good job of that. There are three primary benefits. The first is that eligible gains may be deferred until as late as December 31st, 2026. The second is that for those invested in a qualified opportunity zone fund prior to 2022, their basis could have been increased 10 or 15% of the deferred gain, depending on the holding period. And finally, the most important benefit, in my opinion, is that if a taxpayer makes the election and meets the 10-year holding period, the appreciation should be tax-free. How long is your capital gain deferred until? Well, I mentioned 2026, but it's actually the earlier of an inclusion event or December 31, 2026. An inclusion event's an event that reduces or terminates the investment in a qualified opportunity zone. An example might be if somebody were getting divorced and they transferred this investment to the divorcing spouse, that would be an inclusion event and would accelerate the deferral period so that you wouldn't get to defer it until December 31, 2026 if that transfer occurred before then. The 180-day investment period is a very important timeline to remember. Eligible gain that's deferred must be invested within a 180-day period. This period begins on the day the gain would have been recognized for federal income tax purposes if an election to defer the gain was not made. Let's look at a timeline. Let's assume that the first thing that we're looking at is a capital gain being recognized. Secondly, we talked about we need to invest in a qualified opportunity zone fund within 180 days of when that gain was recognized. That gain then can be deferred for as long as 2026. And finally, if that investment is held for at least 10 years, then when the investment finishes or is redeemed, all of the appreciation from the moment you invested through that 10-year period should be income tax free. Let's look at a more concrete example. Let's assume that you had $1 million of capital gains recognized on December 15th, 2021, and you decided to invest $1 million into a qualified opportunity zone fund to defer the entire $1 million in tax. You would have to make that investment by June 13th, 2022. If you did, then if there was no inclusion period, you would be able to defer the gain from 2021 to 2026. And as mentioned earlier, if you hold that investment for at least 10 years, then at the end of the 10-year period, the investment may be liquidated with no tax on the appreciation. Individuals, C corporations, partnerships, S corporations, trusts, and estates are all eligible for these benefits. Eligible gains include capital gains and qualified 1231 gains, but only gains that would be recognized for federal income tax purposes before January 1, 2027. Short-term gains and long-term gains both qualify. Mutual fund distributions that are characterized as long-term or short-term capital gains also qualify. How do you make the deferral election? The election is made on the federal income tax return in the year that the tax would originally have been recognized. If you've already filed your return, you can simply file an amended return in order to make this election. Can you use property instead of cash to invest in the Opportunity Zone Fund? Well, Only if the Qualified Opportunity Zone Fund allows it, then yes, you can transfer property instead of cash. However, be aware that the gain that's going to be deferred in that example is limited to the cost basis of the contributed property. Let's go through a comparison of investing $1 million in a Qualified Opportunity Zone Fund as opposed to investing $1 million in a conventional investment. Let's assume in both cases that the investment grows at 9% a year and that the combined federal and state capital gains tax rate is 30%. In the first example, investing in the Qualified Opportunity Zone, if you hold it for at least the 10-year period, on an after-tax basis, you'll receive $2,020,000. In a conventional investment, the after-tax money received would only be $1,554,000. So the benefit in this example of investing in a Qualified Opportunity Zone Fund would be $466,000 after tax. There are a number of other important assumptions to be aware of. The two that I want to point out are, number 3, that state taxes are taken into account, and it's assumed that the state recognizes qualified opportunity zones. Not all states do, so check and make sure that your state allows the same benefit that you would be entitled to from the federal government. The other important point is number 5. This is for illustrative purposes only. There's obviously no guarantee of the returns or future tax rates, and we'll talk about that in a moment. What are the considerations in investing in a Qualified Opportunity Zone Fund? The first is, forget about the tax benefits. Is it a good investment to begin with? Does the sponsor have a good long-term track record? If there were no tax benefits, would you make this investment? Next, will capital gains rates be higher or lower when the deferral period ends? In the example of recognizing gain in 2021 and deferring it until 2026, that sounds great. But what happens if capital gains rates go up and the taxes you pay in 2026 are higher than they would have been in 2021? Now the taxes are working against you. Also, how much of the capital gain that's deferrable should be deferred? So I showed an example of $1 million and deferring the whole million. It's not an all or nothing. You can defer any part of that $1 million. So for example, you could defer 400,000 of the million gain by investing 400,000 in a Qualified Opportunity Zone Fund. But that the amount that you invest in that fund may be limited to the amount of cash you have available to make that investment. Well, the investment, the amount of cash you invest doesn't have to be linked in any way to the gain that was recognized that you're deferring. You still have to have that much money around in order to invest in the Qualified Opportunity Zone Fund. That may be a limitation. Also, is the amount to be deferred meaningful enough to make a difference when you look at the totality of your financial picture? The biggest benefit, as mentioned earlier, will likely be the elimination of gain on appreciation. The question is, can you afford to hold the investment for the full 10-year period? Thank you for listening. If you have questions about opportunity zones, feel free to email me at rsiller@sillerandcohen.com. Please visit sillerandcohen.com for more of our insights. Thank you for listening to this Wealth Unpacked session.